Our own Jack Palm Beach Otter is in Florida this week hosting the Barron's Top Women Advisors Conference. He sat down with Nuveen CIO Saira Malik for an exclusive look at the investment manager's playbook for the new year.
Sarah, thanks so much for joining us.
Thanks for having me.
So you have given Barron's an exclusive look at Nuveen's 2023 playbook for investors. One thing that caught my eye first, of course, inflation is on everyone's mind, and you seem to be on board with the emerging Wall Street consensus that we've seen peak inflation, but you're not so optimistic that we're going to be getting back to where we want inflation to be, 2%-ish, in a real hurry.
Yeah, the landscape is shifting from inflation risk to recession risk because of the aggressive monetary policy that we've seen. And if we look at markets, they've been pretty optimistic recently because inflation has peaked and China's moving towards a reopening. But we're going to have to face the music in 2023 around three key issues. One is inflation and at what slope does it decline? Second is recession risk and how deep will it be? And third is continued monetary policy issues and what does that mean for the markets in terms for higher for longer rates, but for how long will that last?
So you said the question is not whether we're going to have a recession, but how deep will it be? Can you answer that? What's your best guess? And how long will that sort of slow economic period last?
I think odds are because of the extreme tightening that we've seen, we do get some form of a mild recession. Factors that we're watching to determine how deep it will be manufacturing data, which has moved to contractionary territory. The consumer remains strong, but they're dipping into their savings rates in order to continue to spend. And of course, employment and wage inflation are very important in determining what the Fed will do. Employment markets remain strong, but if they don't remain strong in 2023, that's another sign that we're going to hit a recession.
And while the numbers on the surface are strong, we've certainly seen a lot of anecdotal reports of layoffs. So it feels like we're kind of beginning that process. That's painful, but the Fed wants to get us there. But here's the key point. What should investors be doing? What kind of stocks can perform well in that kind of environment?
You want to look for companies and strategies that are resilient to a recession, also where you can generate the highest total returns. That's why we're a little concerned about equities at these levels. So areas such as infrastructure companies, which tend to be more recession resilient because they're in waste management sectors and utility sectors, also in equities. Dividend growers, these are companies with strong balance sheets that consistently increase their dividends. It gives you some volatility protection and income while we continue to go through this turmoil.
So I guess you keep the lights on, you keep putting out the garbage even in a recession. Yeah. One stock pick that caught my eye was Zimmer Biomet. During the pandemic, people just cut out elective surgeries because the hospitals were full. That's over. So now what, are people going back to get those hips and shoulders replaced?
Sure. This is a great post-pandemic play. Healthcare is an area that tends to continue to grow even in a weaker economy. People will be going back now to do more procedures now that COVID is moving behind us. There's also a secular trend of aging demographics that's good for Zimmer Biomet. And finally, they should have revenue growth and be able to continue to maintain their margins going forward. Margins are another issue for 2023. They're at about peak levels overall for companies. And as these inflationary costs continue to work through, we think margins could have downside if companies can't grow their revenues with either higher pricing or volumes.
But that's a pretty high margin business.
It is.
One more pick, and that's Linde Gas. Not very well known. I think it's a German industrial.
Yeah, we love industrial gas companies because they tend to continue to grow even when the economy is weak. They have a nice dividend yield of over 1% and a clean energy story as they continue to move towards cleaner technologies. It's a company that tends to beat and raise on the quarter, which is what they just did, and give conservative guidance going forward. So it's a well-positioned industrial gas company that could be resilient in a slower economy, which is what we're expecting.
Before I let you go, let's quickly hit bonds. They were supposed to be the safe things that protect you when the stock market goes down. That didn't happen. But that hike in yields was painful in the short term. In the long term, it means you're actually getting a return from bonds. And I guess if the economy slows, that high-quality bonds might be a good place to be.
Well, this typical 60-40 equity bond portfolio that investors tend to rely on has not worked well this year. They both showed significant declines. Now, a lot of the pain has been priced into fixed income because the peak of interest rate increases are behind us. So while the Fed will put more moderate interest rate increases in going forward, we think it's going to be less impactful for bonds. So we like high-quality bonds, like investment-grade bonds. The total returns are almost at equity-like levels going forward. So investment-grade bonds and also municipal bonds are interesting because the fundamentals of municipalities remain very strong, and the total returns look higher than we've seen in years, even decades at this point.
And we're hearing from advisors at this very conference, they're happy that finally their clients can get some real returns from their bond portfolio.
Yeah, I think that's important, especially in an inflationary environment where we need to earn returns that beat inflation in our portfolios.
Saira Malik, thanks so much.
Thanks for having me.